Today I will present a risk management analysis of Palantir technologies. Before discussing the risk framework, it's important to understand what Palantir actually does. Palantir is a software company focused on data integration, artificial intelligence, analytics, and operational decision making. Its platforms are used by both commercial organizations and government institutions. The three main platforms are Foundry, Gotham, and eFoundry is mainly used by commercial companies. It connects data, analytics, and operational workflows to improve management and decision making. Gotham is a Palantir's government and defense platform. One example is US Army, where Palantir supports multi-domain decision making and mission support. EP or artificial intelligence platform connects large language models, AI agents, and automation to internal business data and process. The name Palantir also has symbolic meaning. In The Lord of the Rings, Palantiri were seen stones used for long-distance communication. This reflects the company's core idea, connecting information across complex systems to support better decisions. Palantir was founded in 2003 by Peter Thiel and Alex Karp. The company's early development was closely connected to the US intelligence community. Between 2003 and 2008, Palantir focused mainly on software for national security, intelligence, and counterterrorism use cases. The origin is important because Palantir is not typical enterprise software company. Its brand and business model has always been connected to government, defense, intelligence, and high-stakes decision-making. In the 2010s, Palantir expanded beyond government work and began serving commercial enterprises. This allowed the company to move into sectors such as healthcare, manufacturing, energy, finance, and logistics. In September 2020, Palantir went public through a direct listing on the New York Stock Exchange. In 2023, the company launched EP, which increased its position in enterprise artificial intelligence. Palantir operates at the intersection of enterprise AI, data analytics, government technology, and defense software. Its competitors can be divided into three main groups. The first group is big tech and cloud providers, including Microsoft, Amazon Web Services, Google Cloud, Oracle, and IBM. These companies have large cloud ecosystems, strong AI capabilities, and deep enterprise relationships. The second group is data and AI platform companies, such as Databricks, Snowflake. These companies compete in analytics, data infrastructure, and enterprise AI workflows. The third group includes government, defense, and system integrators. The market opportunity is big. Worldwide AI spending is estimated at around $1.75 trillion in 2025 and is forecast to reach around $2.52 trillion in 2026. The key point is that Palantir operates in a rapidly growing market, but competition is also increasing. This slide shows why Palantir has attracted so much investor attention. Since the end of 2022, Palantir's share price has increased dramatically. This growth reflects a major change in investor perception. In 2022, Palantir was still viewed by many investors as a controversial government software company with uncertain profitability. From 2023 onward, the AI narrative became much stronger. 2024 and 2025, the company gained even more attention due to commensurate growth, profitability improvements, and strong demand for its product. Another important point is government exposure. Government customers represent 54% of the revenue. This creates a dual effect. On the one hand, government contracts may provide stability and strategic importance. On the other hand, reliance on public sector demands create dependency and political risks. Palantir is also one of the most controversial technology companies in the market. This matters because public criticism can affect reputational, stakeholder trust, and the contrast relationship. The first major criticism is surveillance and civil liberties. Critics argue that Palantir's platform can enable large-scale data integration, and monitoring, especially when used by governments, police, intelligence agencies, or migration authorities. The second area is ICE and immigration enforcement. Human rights groups have criticized Palantir's role in the US immigration enforcement and deportation system. The third issue is military AI and warfare. The final section covers Jeffrey Epstein related files. Overall, these controversies create reputational, ethical, privacy, and political risks. This slide explains why Palantir needs an integrated enterprise risk management framework. First, Palantir works with sensitive data. Palantir has significant AI and cybersecurity exposure. Third, Palantir has public sector dependency. Fourth, the company faces reputational pressure from surveillance, defense, immigration, and healthcare data controversies. Fifth, Palantir has financial exposure, including market risk, credit concentration, liquidity risk, and interest rate risk. Finally, the company has regulatory exposure. The key message that Palantir needs an integrated framework to protect compliance, reputational, and long-term value. The first risk is market risk. Palantir is exposed to share price volatility, AI sector re-rating, and shifts in investor sentiment. Because the company has experienced a very strong stock price increase, its valuation is sensitive to AI growth expectations and macroeconomic conditions. The second risk is credit risk. This is the risk that a customer delays or fails to pay a month's due. For Palantir, concentration in large customer receivables can increase exposure to delayed collections. The third risk is liquidity risk. Palantir must be able to fund short-term obligations, including payroll, research and development, cloud commitments, and working capital needs. The fourth risk is interest rate risk. Palantir holds cash and US Treasury securities which can be affected by interest rate movements. The fifth risk is customer concentration risk. Dependence on a limited number of major government and enterprise customers can create revenue volatility. The sixth risk is government contract dependency. Reliance on public sector budget and procurement cycles means that contract delays, budget change, or failed renewals could affect revenue growth. This slide focuses on high sensitivity non-financial risk. Legal and regulatory risk comes from privacy laws, AI regulation, procurement rules, and litigation. Non-compliance can lead to fines, restrictions, or contract disputes. Reputation risk is especially important for Palantir. Public controversy around ICE, warfare, or healthcare data can damage trust and stakeholder confidence. Political and geopolitical risk comes from conflicts, sanctions, public sector budget change, and shifts in defense policy. Examples include Israel-Gaza, Ukraine, and election-driven change in government priorities. Terrorism and conflict risk is linked to Palantir's defense, intelligence, and counter-terrorism environments. Human rights and ethics risk arises when clients or use cases create civil liberties or human rights concerns. Operational risk is the risk that internal process, deployment execution, or implementation fail. This could include software rollout delays, integrational issues, or workflow breakdowns. Cybersecurity risk is one of the most critical risks. Palantir works with sensitive government and commercial data. Data privacy risk is also central. Personal or sensitive data must be handled under strict privacy rules. AI governance risk is increasingly important because it connects AI models and agents to real business process. Third-party and cloud dependency risk comes from reliance on external vendors, cloud providers, and partners. Product and platform failure risk applies to Gotham Foundry, IP, or Apollo. Platform instability or failed implementation can reduce customer trust and affect renewals. Environmental and ESG risk comes from emissions and disclosure expectations. implications. For Palantir, data infrastructure, travel, and reporting quality can affect investor and client perception. Talent retention risk is important because Palantir depends on engineers, AI specialists, and key leadership talent. Losing critical staff can slow innovation and weaken delivery. Competitive risk comes from intense competition in AI, cloud, analytics, and defense technology. Intellectual property risk includes IP disputes, data rights issues, or technology imitations. Disaster recovery risk is a risk that critical operations are interrupted, cyber incidents, or infrastructure failure. Finally, black swan or extreme event risk refer to low probability but high impact events. For Palantir, examples include a major AI misuse scandal or sensitive government data crisis. The risk register is important because it structures each risk by category, title, cause, event, and consequence. For market risk, the cause is exposure to AI sector valuation change, macro shift, and investor sentiment. The event in sharp price volatility or market re-rating. For credit risk, the cause is concentration in large customer receivables. The event is delayed payment on or counterparty default. For liquidity risk, the cause is payroll and cloud commitments require steady cash coverage. Customer concentration and government contract dependency are strategic risks because reliance on large customers and public sector procurement can create revenue volatility and pressure on the contract pipeline. Operational risk is caused by possible failures in internal process, implementation, and delivery execution. The event could be rollout delays, integrational issues, or workflow breakdowns. Cybersecurity risk is caused by the fact that sensitive government and commercial data attracts cyber threats. Data privacy risk is caused by the need to handle personal and sensitive data under strict rules. Misuse, exposure, or improper handling can lead to compliance breaches, fines, and loss of trust. AI governance risk is caused by the possibility that AI models produce inaccurate or under control outputs. Third-party and cloud dependency risk comes from reliance on external vendors and cloud providers. Legal and regulatory risk is caused by exposure to privacy laws, AI rules, procurement requirements, and litigation. Reputation risk is caused by public controversy around War eyes or healthcare data. The event may be negative media, activism. Political and geopolitical risk is caused by conflict sanctions, policy shifts, and public sector budget change. Terrorism and conflict risk is connected to Palantir's defense and intelligence environment. Human rights and ethics risk occurs when use cases raise civil liberties or human rights concerns. Environmental and ESG risk is caused by emissions, sustainability pressure, and ESG disclosure expectations. Weak ESG reporting or high impact footprint concerns can create investor pressure. Talent retention risk is caused by competition for engineers, AI specialists, and key leadership talent. Competitive risk is caused by intense competition in AI, cloud, analytics, and defense technology. Reviews may pressure pricing, product relevance, or market share. Intellectual property risk is caused by IP disputes, data right issues, or technology imitations. Black swan risk is the possibility of the severe or unexpected event, such as a major AI misuse scandal or sensitive government data crisis. The vertical axis shows probability from unlikely to definite. The horizontal axis shows impact from insignificant to catastrophic. Green areas represent low risk, yellow represent moderate risk, orange represent high risk, and red represents critical risk. Some risks have a lower probability and lower impact, such as interest rate risk and ESG risk. These still need monitoring, but they are not the most critical risks from Palantir. Moderate to high risk include market risk, political and geopolitical risk, legal and regulatory risk, and operational risk. The most critical area includes cybersecurity risk, AI governance risk, black swan or extreme event risk, and catastrophic product or platform failure. The purpose of this matrix is to prioritize management attention. Risk in the red and orange zones should receive stronger controls, more monitoring, and board-level reporting. Credit risk: Palantir should monitor receivables and customer concentration, apply expanded credit loss assessment, and straighten contract and billing controls. For liquidity risk, the company should maintain strong cash reserves, use maturity letter monitoring, align inflows and outflows, and preserve funding flexibility. For market risk, Palantir should diversify its revenue mix, monitor valuation and macroeconomic conditions, and straighten investor communication and scenario analysis. For interest rate risk, Palantir should monitor the duration and sensitivity of its cash and securities portfolios. Government contract dependency. The treatment is to expand the commercial customer base and reduce reliance on public sector revenue. Cybersecurity risk requires zero trust access, login, penetration testing, incident response, and continuous monitoring. AI governance risk requires model testing, human-in-the-loop oversight, auditability, red team exercises, and continuous evaluation. Overall, risk treatment should reduce the impact of the most critical risks. Risk management is not a one-time activity. It requires continuous oversight, measurement, and improvement. The risk register should be reviewed monthly to ensure that risk owners and treatment plans are up to date. The key risk indicators help detect changes in risk levels early. This should be monitored continuously, daily or weekly, depending on the risk. Control effectiveness should be reviewed quarterly through self-assessments, testing, occurrence, and internal audit findings. Compliance and regulatory monitoring should track legal updates, regulatory changes, and policy requirements. Risk appetite and limits should be reviewed regularly to ensure activities remain within approved tolerance levels. The overall risk management program should also be reviewed annually through maternity assessment, benchmarking, feedback, and action tracking. Stress testing is used to assess how Palantir would perform under adverse conditions. In the base case, AI demand remains strong and government and commercial contracts continue normally. The impact is stable revenue growth and manageable risk levels. In the adverse case, new AI or privacy regulation increases the compliance burden. This could increase legal costs, slow the sales cycle, and delay client onboarding. The response would be to strengthen AI governance, legal review, and privacy by design controls. In the severe case, Palantir faces a major cyber attack or sensitive data break. This could lead to legal penalties, contract superstition, reputational damage, and loss of client trust. In the severe case, Palantir faces a major cyber attack or sensitive data break. This could lead to legal penalties, contract suspicion, reputational damage, and loss of client trust. The management response would be to activate the incident response plan. In the geopolitical shock scenario, escalation in Israel, Gaza, Ukraine, or changes in the US defense policy could increase public and contract uncertainty. The maturity gap model compares rate-sensitive assets and rate-sensitive liabilities across different maturity buckets. For Palantir, rate-sensitive assets include cash, money market funds, short-term treasury securities, longer treasury securities, and long-term investments. The maturity gap can be positive or negative. If Palantir has more rate-sensitive assets than liabilities in a time bucket, it may benefit from higher rates through higher interest income. However, change in interest rates can also affect the fair value of treasury securities. The maturity ladder compares expected cash inflows and expected cash outflows across different time baskets. Palantir inflows include cash balance, receivable collection, customer payments, contract billings, renewals, government and commercial contracts, long-term contracts, and investment income. Outflows include payroll, suppliers, cloud services, sales costs, taxes, lease, cloud commitments, operational cost, and expansion cost. The liquidity gap is the difference between inflows and outflows. If inflows are greater than outflows, Palantir has a surplus. If outflows exceed inflows, the company may face liquidity pressure. For Palantir, credit risk does not come from lending like a bank. It comes mainly from from account receivable and customer concentration. The expected credit loss is the estimated loss that Palantir should recognize or monitor for receivable risk. In practice, Palantir should monitor overdue receivables, assess customer concentration, apply credit reviews, and update allowance for credit losses when necessary. For Palantir, derivatives are not central to the business model because the company is not a bank or commodity producer. However, they may be used selectively if financial exposure become materials. We can use forwards, interest rate swaps, options, or index hedges. So the key point is that the derivatives should be used for hedging and risk reduction, not for speculation. This slide explains the difference between black swan and gray rhino risks. A black swan is an unexpected, rare, high-impact event. For Palantir, an example would be a sudden major AI misuse scandal or massive government data breach. A great rhino is different. This is an obvious, visible, high-impact risk that may be ignored or underestimated. The difference is important. A black swan is unexpected. A gray rhino is always visible. Gray rhino for Palantir is tightening AI regulation and growing criticism around surveillance technologies. For Palantir, AI regulation and public backlash are not surprising risks. They are already developing. If the company does not manage them proactively, it may face higher compliance costs, reputational damage, and regulatory restrictions. A BCP or DRP plan ensures that Palantir can maintain critical operations and recover quickly after a cyber incident, data breach, cloud outage, platform failure, or geopolitical disruption. For Palantir, this is especially important because its platforms support mission-critical government, defense, healthcare, and commercial operations. The plan should also include notification of affected clients and regulators, escalation to senior management and the board, and regular testing through simulations and tabletop exercise. For Palantir, stricter AI regulation can create a growth opportunity. Cybersecurity pressure can also increase demand for Palantir's secure data infrastructure. Geopolitical instability may increase demand from defense and government clients. Reputational risk can be reduced through transparency, privacy by design, stakeholder communication, and human rights due diligence. Commercial expansion is also an opportunity because it can reduce dependency on government contracts. The key idea is that Palantir should not only defend against risk, it should also use risk management to create competitive advantage. Risk treatment is not the end of the process. After mitigation actions are applied, each risk should be reassessed to determine the residual risk. For example, cybersecurity and data breach risk may initially be critical with a score of 20. After zero trust access, audit logs, and incident response, the risk may fall to high with a score of 12. However, it still requires continuous monitoring. AI governance failure may also fall from critical to high after model testing, human-in-the-loop oversight, audit trails, and explainability. But the risk remains because AI systems are complex. Legal and privacy regulation risk may fall from high to medium after compliance frameworks, legal monitoring, and privacy by design. Reputation controversy may fall from high to medium after transparency, stakeholder communication, and human rights due diligence. The objective is not to eliminate all risk completely. The objective is to reduce them to an acceptable level with Palantir's risk appetite. To conclude, Palantir is a high-growth AI and data analytics company operating in a high-risk environment. Its major opportunities come from artificial intelligence, government demand, defense software, and commercial expansion. However, these same areas create major risks. The most important risks include cybersecurity, AI governance, legal and regulatory exposure, reputational pressure, public sector dependency, geopolitical risk, privacy concerns, and technology failure. The risk register and risk matrix help prioritize the most serious risks. Stress testing, maturity gap, maturity ladder, derivatives. Reevaluation after treatment make the framework more practical and aligned with assignment requirements. Overall, Palantir's long-term success depends not only on technology and revenue growth, but also on its ability to manage trust, compliance, resilience, and stakeholder confidence.